All right, ladies and gentlemen, welcome back to FreightWaves today. It's been a great episode, and second hour is just getting started. Let's get to the Freightonomics of it all. And joining me again is the guy, you guys know this man very well, Zac Strickland. Zac, what's up, man? How are you?
Malcolm, doing great. Freightonomics on FreightWaves today.
Come on.
I mean,
Come on.
let's go.
Debut.
A full debut of an hour. For those of you that aren't familiar with Freightonomics, welcome to the show. We combine freight market dynamics and economics into something.
Yeah, I love it. I love it.
So, Malcolm, you're kind of kicking us off here on the inaugural FreightWaves Today version of Freightonomics. But traditionally, what I do is I kick off with a market in two, where I throw a bunch of data at our viewers to get them started.
Okay, well,
If you want to count me in, we
just a simple 3, 2, 1.
just you, however you want to do it.
All right, let's go 5, 4, 3, 2, 1.
Let's kick things off. The first chart of the market in two is going to be the S-Tri Sonar Truckload Rejection Index. You've seen Craig throw this up here this week. This is the seasonality view, and you can see clearly that the white line there, which is the current year tender rejection rate, is way above the one of the last 3 years, and we're continuing to see that climb. I think a lot of people expected this number to start to decline a little bit after Memorial Day, but we've had some nuance this year in the form of broker liability, continued capacity exodus, that has really kept this market on its heels, and it looks like it is not showing any sign of slowing down, at least in the month of June. Seasonally speaking, there is not a lot of reason to expect it to slow down until about mid to late July. So let's go to the next chart. Dive on in to the WRI map, if we have that one pulled up. So this is just going to show you where in the country our rejection rates continuing to climb the most meaningfully when we combine volume and weekly change in rejection rate. And that looks like the Southeast and portions of the upper Midwest around Indianapolis, Columbus, Ohio, a lot of DCs and everything. And then we also have the West Coast remaining to stay active. It's produce season out there, so probably a little bit of influence there, but we are watching the ports of Los Angeles and Long Beach for some pressure later in the year. Let's go to the next chart. There's going to be the spot rates, NTI, FTI, and RTI, all of them continuing to climb. There is no sign of pausing here. Continued pressure on the van market that seems to be outpacing the refrigerated market. Still, flatbed just seems to be there's no end to that. Let's go to the next chart. Look at the van spot rate map. Notice all the blue. Those are all increasing markets over the last 4 days. Not a lot of red on here. The Northeast appears to be the softest, and now we're starting to see a little bit of that softening signal going down in the Florida markets. Let's go to the last map here and look at the refrigerated side. Again, somewhat surprising that refrigerated has more downward pressure than a lot of the van market pressure has existed. So, the red there in the mountain region, not terribly unexpected, but at the same time, the way this market continues to just exceed expectations. I don't like, there's always some sort of nuance every time we see these market flips.
Yeah.
And I would not have called like the refrigerated market being one of the ones that had a little bit of a quieter start here.
Not at all. I just have to say real quick, you make the hard stuff look so simple. I'm sitting over here in amazement because this guy, I mean, kudos to you, man. Seriously, this is awesome. This is awesome. And with that, I just want to say, I'm not saying I got to go home, but I got to get up out of here. And that's the thing. I cannot stay here. That's the saying. And I said that you made.
Do we need to put on closing time?
No. We're good. We're good. You make the hard things look simple, but also RXO can also make it simple as well. You guys see what I did there? Because get reliable, again, capacity, and it can be complicated. RXO makes it simple. As the third largest provider of broker transportation in North America, RXO has the scale, resources, and expertise to help you tackle any shipping challenges. From a last-minute spot load to a managed transportation solution, from LTL to intermodal, from train logistics experts to, again, AI-powered freight automations, RXO has you covered from first mile to last mile. Start shipping on easy mode with RXO and get smart solutions to move your freight today. Learn more at rxo.com/capacity.
All right, Malcolm, man. Well, I appreciate you kicking us off today. For those of you that aren't familiar with the Freightonomics show, we have Dr. Zac Rogers coming on here in a little bit. He is going to give us a lot of update here on the Logistics Managers Index, which he co-authors with several of his compadres out there. But first off, I want to run through a few things, and I also kind of want to set the table for our friend Dr. Rogers. Economically speaking, we have had quite a bit of activity here over the last bit. The ISM came out, and it looks like, we heard Craig talk about this earlier in the week. The manufacturing sector, a bit of a conundrum to me. I think data center production and things like that really having an influence here domestically, and it's creating a little bit of muddiness in the interpretation ability, at least on my end. I'm not a full-blown economist by any means, but ISM continues to show expansionary signals. You'd see the new orders growing, production, employment contracting, deliveries are slowing, raw material inventories are contracting, kind of a positive signal there when we see inventories start to decline faster than they get replenished. And then customer inventories are too low. So it's almost like there's a signal here in the ISM that suggests the manufacturing sector, and Dr. Zac Rogers has said this in the past, where we see a little bit of this cautious ordering, where we see a little bit of pull forward, but maybe not enough to commit to the rest of the year because we're keeping our customer inventories too low. And maybe the demand is exceeding expectations in the manufacturing sector. So I do feel like there is something to really unpack here, and we'll get him on in a minute. Industrial production also continuing to grow here over the last bit. Like this is some of the strongest industrial production activity. Of course, we're talking about mining, energy, utilities, all involved here. And of course, energy, a huge component of what's going on with the Strait of Hormuz as that begins to really drag on longer than a lot of people expected. In the news, there's a big story that's kind of, I don't know, I feel like it's a little bit buried right now. And it's in the form of a tariff that the administration has said that they are going to levy an additional 10 to 12.5% tariffs on about 60 countries for utilizing forced labor or goods manufactured with forced labor, and they haven't necessarily done enough to curtail this. The economics of this are obvious. The moral reasons are also obvious, but there's also a little bit of distrust going on in the global economic environment right now in terms of the motivation behind these, as the administration in the past has really shown their emotional frustration with not being able to levy the IEEPA tariffs, which got struck down in January. So these look eerily similar to what we saw there. And so, again, nobody wants forced labor or anything like that, but that goes under review July 7th. So there's going to be time. Obviously, some businesses have stated that there is no validity to this, and they're going to get their chance to voice that at the hearing. So definitely something to look for. Some of the countries involved, Canada, Mexico, they've stated that Mexico, anything negotiated under the USMCA agreement is going to be exempt. So it's not everything there. They're on the table for about a 10% additional tariff on those goods. We've got Taiwan also on that 10% docket, or slated for that 10% increase. China, Japan, India, Vietnam also face 12.5% because that tier is supposedly not doing enough to enforce. They're not doing anything to enforce this forced labor manufacturing caveat that's going on. So the next piece of the story here, Stuart Charles wrote an article this week on, we've got the box rates shooting up. I wrote a chart of the week on this last week about rates on the ocean, maritime container rates increasing pretty significantly. They just took another GRI on the heels of the article that I wrote. So Stuart definitely updates this one. Peak season surcharges are cited in here. We're about to hit that maritime peak cycle here in July-ish. I mean, nobody really knows when peak season is going to be anymore based on a lot of these trade policy or erratic movements. We traditionally see peak season for maritime imports late July into late August. That hasn't materialized yet, so there's not really a lot of demand-side signals going on here. Obviously, fuel costs are a component. It's inflationary for rates in general. This is going to be an ongoing story as we continue to unpack inflation and what that means, especially as a derivative of all of the input costs from energy and the subsequent lack thereof. So certainly going to be a story to watch moving forward. It's interesting that we're seeing rates percolate this early. And then we're also slated, he cites that come mid-June, there's also another GRI supposedly going to be implemented for a couple of the other carriers like CMA and CGM. So it's, this ongoing discussion about inflation. Transportation costs are inflating, and it's not necessarily entirely because of fuel, but it is part of the equation. The next thing that he states in this article is that fertilizer. So this is interesting to me, this angle of fertilizer. We don't realize how much of our stuff is a derivative of this region. It's not a heavy outbound outside of energy, but some of the things that are impacted, fertilizer, obviously it's the peak season for produce and a lot of the crop rotations. If you read the Sonar sit rep that we have in there for the Sonar subscribers out there, we talk about how this is really the convergence of every single harvesting region in the that involves inbound into the United States occurs in June. We have this, it's not the peak season for necessarily the total volume for each region, but it's the convergence of all regions producing simultaneously that really drive a lot of this activity. California, of course, is in their peak harvest cycle out there on the West Coast, and it's something to monitor. But produce rates starting to increase. And I'm interested to see this one moving forward because, this is transportation costs, the USDA. We're seeing produce rates increase. Now, if you look really closely at this chart, I've got a line buried in here called the RTI. You saw the RTI earlier in my Market in 2 update. RTI has this little, it's going up too. Some of these produce rates are increasing above, some of them are increasing less than the RTI. That is the market signal. So sometimes produce rates are just increasing, not because we see demand, but because the overall market is inflating these prices. And I think that's one of the big lessons here is that just because we're seeing rates increase does not mean that we're having the underlying demand characteristics in an environment like this. It is a very supply-centric type market where we're seeing this contraction really apply to rates. And I want to pull up the chart of the IOTI as I pull it back into the maritime space because we are not seeing huge signals from the bookings data. This is the inbound ocean TEUs index, which is the time of booking containers. So they haven't shipped yet, but they're about to. And then when they do, they hit the water and it takes about 15 to 20 days, depending on where they are in the entire world, but 15-ish days from Shanghai to Los Angeles, Long Beach, which is a big lane corridor. It takes about 30 days to get to the East Coast from China. And of course, the Suez Canal and all that remains relatively closed and inoperable. But this is a very good leading indicator for demand side stuff here for about 6 to 8 weeks in advance. Very retail-centric data set. So last year, that yellow line was peaking in late June, early July. And of course, the trade policy, I almost want to just erase the yellow line from this chart because last year was such an anomalous behavioral lack of seasonality type thing. We did see a pretty decent year-over-year growth in May in terms of overall imports, but it's because we had Liberation Day tariffs and China really removed from the equation for about a month there. So beating last year on imports, not a hard thing to do. But we are going to monitor, I think, looking here late July, if this index is not really showing signs of significant upward pressure or growth, we do have some concerns from a demand side economics standpoint. The last thing I want to hit on before I bring on Dr. Rogers is this diesel story. Now, the price of fuel. John Kingston was on earlier in the week. Please go back and watch him. He knows more than I ever will about anything about oil and crude prices and oil markets. But this is an interesting take because a lot of people think, oh, oil prices go up. That's what's driving transportation prices up. We've had this conversation a lot on this show. It's not always easy to pass along all these input costs. How many input costs, and we're going to talk about this here in a minute, in the form of PPI and CPI, there's a lot of input costs that happen underneath the retail figures to the consumer. They don't get passed along immediately. Sometimes it takes months, sometimes it takes weeks, sometimes it takes years before we see the underlying inflation on the input cost show up to the consumer. And that's typically happens in transportation in the form of fuel prices or insurance costs or labor costs, et cetera. Everything that goes into moving freight doesn't necessarily always have an influence on the outward rate that you see. Diesel prices, if we pull up the chart, looking at retail and wholesale prices, we're seeing some downward pressure in oil. And John Kingston points out in his article here that this is somewhat of a conundrum. And I think this is just a byproduct of speculatory behavior in this market where we saw prices increase on the expectation of lower supply. So they're actually still not getting enough oil to keep those buffers restocked, which we are gradually working our way towards the bottom of that barrel. And a lot of the oil executives cited in this article state that they are actually seeing we're getting dangerously close to a threshold where we don't have enough buffer or stock, global energy supplies, mind you. So this is going to be a concern as the conflict continues to move. But in the meantime, the diesel market is signaling things are getting better and improving. And I don't know if the underlying thing is actually true here. So for now, enjoy a little bit of lower fuel and transportation prices, but not something I would think you want to just call off for the rest of the year, at least until we get some more clarity around that. One more thing, I know I said one more thing, but one more thing I want to call out about this market is the fact that we are encountering something that we haven't seen in 3 years. And it's in the form of rates going parabolic. And a lot of the conversations that I've had in the space, we've had lots of churn in the industry. For anybody that's procuring freight, transportation managers out there, everybody that's sitting behind a desk, if you just came into the industry in 2023, you think that transportation procurement is about the easiest job you've ever had. Now, if we pull up the chart on the NTI here, the spot, and this is spot rates, mind you, not contract rates, which are long-term and far more stable, although that's becoming less true. But the NTI I want to pull up here, this is the one with all three, but there's another chart that I had a box around. It's number 7 in my charts. I said, there we go. It's got the Bollinger Band around it. And I wanted to just highlight for those of you out there that are unaccustomed to this type of movement in a spot market. It's typical in financials. And we do see this in transportation markets where rates go up so fast that the market really has trouble dealing with it, because you could have taken last week's rate and applied it to today and expect that to stick. If you look at that thin shaded veiled area around this line, you'll notice that there's a line, and it's an average, and it's moving below the actual NTI line there. That means that rates are consistently moving above the average every day. And that's a 14-day moving average. So if you're thinking about last week's rates, you're already out of date. The rates are moving faster than the averages. And that's what a lot of data is based on, is averages or medians, the center point in the data sets. So it's anybody that's looking at data needs to keep in mind that when things are trending higher or lower, mind you, because it works the same way, that you need to apply a level of adjustment, because that is what, it's a lot of the financial markets. This is what they do. They look at the trend line analysis and they apply some sort of premium or discount based on the trend line to what they're looking at. So I highly suggest anyone out there procuring freight keeps in mind, especially on the spot market, that is not a contract or long-term rate chart that I was showing you, but the spot market is behaving very much like a commodities market type deal where we see inflation happening rapidly. So without further ado, I think I was able to really run through some stuff, Dr. Z. I wanted to get through a lot here, but we also have an hour today. So we've got plenty of time to really deep dive into the LMI and some of the economics that I want to talk to you about. But welcome to the new suited up Zach Strickland Freightonomics.
Hold on. I didn't realize we changed the dress code. Hold
on. There we go. There we go. Man.
All right. I'm ready. I'm ready for the new FreightWaves.
Look at you in the summer vacation mode in Colorado, having your suit and tie just ready to go and lecture.
Only for you guys. I might lose the tie because there are some limits to prop comedy on a freight podcast. All right, but yeah, let's talk about the LMI. And I think, by the way, appropriate that we're dressed up for it, because this is a big report in some ways. Yeah. We saw some real movements in our index this month. For those of you who aren't familiar with the Logistics Managers Index, we are a change index, very similar to the PMI, like what you're just talking about. In fact, we shamelessly borrowed their methodology, which they know about. They let us borrow it. And essentially, we ask a whole bunch of folks, director level above, warehousing, transportation, inventories, going up, staying the same, going down from last month. And so we're going to throw a bunch of numbers at you here. Any number at 50 means it's the same. Below 50 is contraction. Above 50 is expansion. So with that in mind, the overall index this month was 69.5, which is pretty robust expansion in the logistics industry. Now that's down like zero point 0.4 points from April when it was 69.9, but 69.5 is still, after April, I think the second highest reading we've had since March of 2022, which was sort of the come down from the previous bull cycle. So things are hot right now in the logistics industry. And I'll let you tell me which one of these metrics you want me to talk about first.
Oh man, I think John Kingston. I was just talking about him and his article, but he gave me some advice years ago when I started at FreightWaves. Don't bury the lead, and I think the lead here is clearly the transportation signal, the one where we're seeing the alligator really open wide. And I mean, you said it in the report; it's an all-time high for anything, right?
It is. So transportation prices came in at 96, which,
Yeah.
our scale only goes to 100. And so transportation prices came on at 96, which is the highest number we've ever had for any metric. And, we've been doing this since September 2016. So in a decade, basically, this is the biggest, the biggest movement we've seen. And really what that speaks to is just the sort of unprecedented way that costs have been going up. I know we're going to talk about the PPI in a minute. One thing I saw, I was checking out the PCE earlier, and we spent, I believe in April, because we have the April numbers. In April of 2025, U.S. consumers spent $418 billion on gasoline and other energy goods. In April 2026, it was $531 billion. So that's a 27% increase just at the consumer level, right? Like leaving out, right? So the PCE, so the producer. So, that's not even really bringing diesel into it much. I mean, my father-in-law has a diesel truck, but he's fringe. But so there's some of that in there, but really the costs are going up so quickly. And on the other side of it, we see that capacity came in at a 31, and 31 that is up from last month when it was 28. But 31 is still a really rapid rate of contraction. Anytime those two lines are like 65 points apart, it means something is happening. I mean, those two spots you have circled there, one of those is the tax cut that happened in the first Trump administration that really sent things spiking. And then that second one there is when two presidents in a row gave us $1 trillion and we couldn't spend it on services. We had to spend it on goods. And so we're at that level. We are at this just meteor shock level right now with transportation. And here's the thing, that yellow line in this third round, that's steeper than either of those other two really were. And especially when contrasted with the steepness that the white line is falling at. I mean, it was only last fall when actually the white line was above the yellow line. And so to change this fast really is pretty phenomenal. And by the way, digging a little deeper into it, it's the smallest ones. The 96 is our biggest number we've ever had, but we always divide this up into different sort of cross sections of the data. Our smallest firms, respondents with 1,000 employees or less, they reported a 98.2 for transportation price, which that is truly, I mean, you can't really go higher. That's basically 100. And so it's really hitting the small firms even disproportionately more than the large firms, which, reported a paltry 93.3.
Paltry 93.3. Yeah, I liked your explanation on, anything basically above 80 is just a statistical nightmare for anyone, or below. Is it below 30 and above 80? That's kind of like in that. We don't see that often.
Once you're below 30 or above 80, we're in sort of an unsustainable pace of movement.
Yeah. So on that note about it's interesting to me. We've been talking about this like K-shaped economy and divergence of experience. Like the haves kind of have the ability to like kind of walk through the water a little bit better than some of these have-nots or the smaller operators. What's your take on the shipping community here in terms of the small businesses? Like, are they really feeling this like disproportionately because they don't have the buying power? What's the story there?
I think that's part of it.
Yeah.
And we also see in the difference in their inventories. So large firms reported inventory level growth at a 59.5. Small firms are 51. So that's like an 8-point difference. Basically, small firms are not building inventories up that quickly, partly because the cost is so prohibitive. I mean, they said 51 for inventory levels and an 85 for inventory costs. So that's a 34-point spread. And by the way, the average spread for costs and inventory levels is about 13 points. And it's 35 right now for our smallest firms. And really it comes down to capacity is very tight. Their warehouse capacity is 44. Big firms have a 58. And because they don't have enough space, and their cost, by the way, 85 for inventory, 71.5 for price, 98 for transportation price. That 71's warehousing. They have like 255 points out of 300 for cost growth. The cost is just disproportionately higher on small firms because of supply and demand stuff. It's going to be more spot in there. It's going to be getting boxed out of like the warehousing space that they would really like to have in some ways. And once again, the other piece we see here is that it's not just the smaller folks, it's the ones in the middle. So wholesalers, distributors, some 3PLs, we see the costs are really high, especially compared to the bigger folks in that industry, because there's just a supply and demand mismatch. And anytime there's a supply and demand mismatch, the people further down the curve are not going to be able to procure the supply that they need, which is going to drive up costs and really constrict capacity, which we're seeing manifested in those very low inventory levels for small firms.
Yeah, so I want to, this specifically, inventory fascinates me at this point. I alluded to it a little bit with the ISM, but I get the sense in the data that, and I've heard this a little bit when I read through some of the media stuff, but I'd like to hear your take on this. But there is a sense that we have somewhat of a conservative inventory management strategy where companies maybe, they don't want to commit to demand being in place for the long term. So the second half of the year, a lot of retailers, I've heard this from the NRF, a lot of retailers are expecting, yes, we're going to order, but we're going to wait basically till the last minute. So that IOTI chart that I showed you, I don't really expect peak season to happen anytime soon for the ordering process. I expect that actually to happen much later this year because a lot of these businesses appear to be increasingly concerned about second half inflation and some of the materials. Now, this is, of course, nuanced in the manufacturing sector, which I think you call out in your report as well, that there's a little bit of pull forward activity. And because that's the upstream, that's the manufacturers, that's the people that are building for the consumers who show up later in the year. So what's your take here? Are we seeing businesses kind of hold back, even though the American consumer continues to almost show up and continue to buy stuff?
Well, the April consumer spending was up like 1.5%. Although when you take gas stations out, it was up like 0.3%. So so there's part of it. And by the way, I don't think that gas station was just Takis and Fantas. I think that was gas that was driving that up. And so that's part of it. The other thing I would say is that we're really seeing, and you mentioned this, two diverging strategies. So on the manufacturing side, it's a pull forward. And a lot of that is nervousness about component availability. If you look at really what the Strait of Hormuz is hitting even harder than, our own gas pumps here in the United States, it's like Southeast Asia. They're having rolling blackouts. They're like, hey, don't run the AC, all kinds of stuff. And so Southeast Asia is where a lot of critical components come from. And it's so interesting to me because what these divergent strategies really are, where retailers, yes, are absolutely holding off, and manufacturers are kind of getting ahead of it. It is exactly a reaction to the problems that each of those groups had during COVID. So think about what happened during COVID. So manufacturers, remember all those pictures of like all the pickup trucks like that couldn't be sold because they didn't have, critical chips or semiconductors or whatever. And then at the same time, remember in 2022 when inflation went way up and all these companies, retailers especially, had way too much inventory. They're taking $1 billion write downs. I mean, Target took a $2 billion write down because of all this inventory they had. And so they both were burned in different ways between 20 and really 21 and 22. Manufacturers had a paucity, a lack of critical components. And so they couldn't make everything they wanted to make. Retailers, the downstream folks, had too much stuff that they couldn't sell because they over leveraged themselves during the crazy buildup period of 2021 and then were left holding the bill, which is one of the things that cratered the freight market so much in late 22 and 23 is that they just weren't ordering anything because they already had too much stuff. And so these reactions that we're seeing now are 100% related. I mean, it's truly a reaction to what happened in 21 and 22, where manufacturers like, okay, we don't want to run out of stuff again, pull it forward early before we have shortages. And retailers are, we don't want to get stuck holding the bag again with too much stuff. Wait a minute, and we'll wait until we see what consumer demand is actually going to be, because the retailers right now, I think, are taking the position that they would rather have not enough and maybe have to pull for. Because the thing is, like, if we have a strong holiday season and we do have to rush everything over and it costs a little bit more, cool. We'll absorb that extra cost because it means that we're going to make it up on the backside really soon. We're not going to have another year like last year where everything for Christmas is here in July and then we just sit on it for 5 months because we have no idea what the consumer is going to do in November and December, especially if, and you were talking about fertilizers a second ago, especially if gas and food keep getting more expensive, it's not going to be a big year for Santa. And so we really see these totally different. I mean, I don't even know if it's K-shaped. It's almost more like a T-shape because they're going in totally opposite directions. Is T-shaped economy a thing? I don't know. But
you just
they're going in totally opposite directions, upstream and downstream, based on what happened to them the last time they got burned.
Yeah, I mean, you're kind of depressing me a little bit. No Santa this year, but we're having Prime Day or week or days here in a few weeks. That's an interesting move. We're earlier than we've ever seen it. Do you think there's some sort of testing the water or trying to get in front of inflation from Amazon here? Because that's a huge, it's typically a huge deal for them. Mm-hmm.
I think so. I think the first Prime Day is always kind of a good canary in the coal mine for if anything is going to change. So I think it makes sense. I also think for them, they do think probably that getting out a little bit ahead of it might not be the worst idea in the world. I mean, we really could see costs increase over the next few months because the other thing that's still out there is tariffs. Yeah. Those still exist. I know it's kind of last year, but the rock and a hard place of tariffs and huge increases in transportation costs. Everyone's trying to thread that needle between big orders and small orders because that's where it would push you. And I think for Amazon, partly they are one of the biggest retailers in the world, so they can leverage some of their scale and they can maybe try to get out ahead of it, because one bet they may be making, or a hedge maybe, is that there might be more discretionary income now than there is in 6 months. The traditional holiday season could be slower. Right now, it seems like consumers are spending. You talked about, we just got tax returns not that long ago, though we're mostly running through it. We do have still some oil reserves. I mean, in some ways, you can almost think of, for the last 100 days since the war started, we've sort of been coasting off of our savings a little bit, both in terms of our tax returns and the oil reserves that we've had. As you mentioned, we're working through those savings. And so Amazon might be thinking, well, let's have a Prime Day now when there's still a little bit left in the bank, instead of 6 months from now when disposable income might be a little lower.
Yeah, I mean, I want to pull up the PPI chart and the CPI chart here just to, this is a year chart. These are hard to look at in a year, I find, but I wanted to focus on the current because the PPI there, which is all commodities, it's not the headline figure that a lot of people look at, which was 6% in April. This is showing about 10. because it doesn't have this other things in it. But it's the CPI, of course, it's always a kind of a lag, and it doesn't necessarily always imply that a one-to-one relationship will happen. This happens, and I was talking about it for transportation earlier. Fuel prices don't always mean rate increases in the spot market, mind you, or for prices in general, but they do sometimes. Obviously, there are upward pressure in the market, and this looks like we're building some upward pressure on inflation in the upstream side of the equation. And, I think some of the businesses, especially some of the ones that I've talked to, are like, we're going to hold because we don't think this is permanent. I mean, we've been signaled how many times that the Iranian thing is going to end. The financial...
a couple times since we started talking, I think.
Yeah, I mean, the financial markets, I talked to one of our friends, who runs a hedge fund, and I was like, man, how long are we going to continue to bite on Twitter or Truth Social posts about the conflict ending and the market jumps up and down? He had a running joke. They all have a running joke about, 2% moves in the market based on tweets. And this, I don't know. I don't think a lot of people have a good sense of how long this is going to go on, but obviously the longer it goes on, at some point that PPI seems like it might break through. Do you have a thought here?
I think so. I think it makes sense that'll continue to push. One of the things that was most interesting to me about the report this month was the split between the delta between inventory levels and inventory costs. I mentioned that on average, we see inventory costs about 13 points higher than inventory levels. Well, this month, inventory levels were 29 points lower. So costs were 29 points higher. And so we had costs in the 80s and inventory levels in the 50s. That's unusual. And basically what that means, that delta being bigger than it's ever been. By the way, our previous high had been November of 2021. The costs were 28 points higher than levels. And that was November 2021, which is like the all-time craziest month that's ever happened, basically. That's when Target was, and Home Depot were like renting fuel tankers to take stuff across the ocean. I mean, that was like, things were crazy in November 21. And now we have this same movement here, and even a little bit more in May of 26. And what that tells me is that we've never seen inventory get more expensive at a faster relative rate. So sort of, if you almost think about it as a per unit level, in some ways, inventories are getting, the cost of inventory on a per piece, per carton, per pallet level is getting more expensive now in the aggregate. Now, I'm sure there's exceptions in different industries, but in the aggregate, it's getting more expensive faster now than we've ever seen it before. And when you think about, okay, is that going to break through? When we looked at our upstream and downstream split for future predictions, and I know we'll talk more about future predictions in a minute, but upstream, they said the inventory is going to be at like 50 over the next year. I mean, partly this is a pull forward. This is a pull forward upstream at the manufacturing level now because of potential shortages. But a year from now, we're not seeing huge expectations of inventories being pulled forward. But what we are seeing big expectations of is the cost of that inventory. So upstream firms said, all right, inventory levels are going to go up at a level of 50, which is basically no movement. Inventory costs are going to be 84.7. So 34 points basically between our upstream levels and cost. Downstream, by the way, is a 68 for levels and a 73 for cost. So they have a 5-point difference. Upstream has a 35-point difference. And so what it tells me, I think, a couple interesting things. One is, yes, the PPI, the cost that producers are paying, I think will keep going up over the next year. But the fact that upstream inventory costs are 11 points higher than what we saw downstream does tell me there is some buffer there between PPI and CPI where we're not seeing maybe all of the costs get passed down. And, we saw this last year with tariffs where everyone, okay, it's 20% tariff. Everybody absorbed 2% maybe, so that by the time it gets to the consumer, we only have to increase prices by 8% or whatever it was. And so I think we're seeing a little bit of that here. I also think that our upstream folks are maybe more directly dependent on places that are being hit harder by Hormuz. And so they're having to deal with the fallout a little, and tariffs probably too.
Mhm.
They're dealing with the fallout a little more directly. And so, yeah, I think that PPI, it is a delay getting down to CPI, but beyond that, I also think there's a buffer where the folks in the middle know that consumers are exhausted. I mean,
Right.
consumers have been dealing with crazy inflation for the last few years. I think they know they can't pass all of that all the way
Right.
down. I mean, look at like Walmart coming out and saying, "Hey, there's certain things we are not raising prices on, no matter what," because they know if they do, then consumers are just going to walk away.
Right. It's interesting because, the consumer confidence has been in the dump for a while and it went to a new low here in the last month, but they're still spending money and, they're still spending at least not proportionate to their, I guess, the way they feel. But I guess also there's a little bit of, what's it called where you go out and you spend, it's emotional therapy, retail
Mhm.
therapy. Yeah. For not feeling great about it. But not getting into the whole K-shaped part of that, but it's, I think you make a good point, is that a lot of that upstream inflation will never see the light of day. And I think a lot of these businesses know that the consumer, especially the lower income, is already kind of hitting their limit. We saw credit levels are starting to climb up. Some delinquencies, credit card delinquencies are starting to creep higher as well. So there's some pressure building in that space. Doesn't mean that we're recession bound by any means, but it does look like there's some things that these companies and businesses are holding back on. They're signaling some things for later in the year that doesn't necessarily mean that we're going to see like the faucet turn on. But on that note, are there reasons that we might see the second half of the year explode and go the other direction?
Well, so one thing I would say that's tangentially related to that is, we're able to bring things over faster in some ways. I mean, COVID was almost like supply chains went to like boot camp. Like it sucked, it was hard, but we're much stronger now, and more resilient. And so partly one of the things that, and I think it speaks to the resilience of supply chains and the ingenuity of supply managers, is that one of the reasons we can delay everything is because we know we now have practice getting stuff here in a real rush
Mm-hmm.
and off of the normal timeline. And so I think that's part of it. Like that is one reason to be optimistic, is that when if things turn around at some point, and who knows, I mean, the Hormuz thing, it's tough to know. And the tariffs do seem to change as well. I mean, you talked about the new 10% stuff that came out last week. But if things cool down a little bit, one of the reasons to be optimistic is that supply chains can like shift quickly. Like we can really change fast and move things over. So that is one reason I think to sort of look on the bright side with some optimism. The other thing I would say, like if you're a carrier too, is because it was a great call out by you. This is not just oil prices that are driving up transportation costs. Part of this is we have right-sized fleets, and demand has been there, and so it's oil is not the thing that pushed us into this freight boom. I mean, it's one thing, but also we had movements in supply and demand where we were getting back into a market with equilibrium. And so I don't think that even if we have a fall off, the impact to freight markets will not be what it was probably in 2022. Partly because inventories are so much leaner now, we can't just sit on our laurels like we did in 22 at the retail level. And secondly, I think we're more prepared for a dip because of the way capacity is structured now relative to 2022. So if I'm thinking about it from the carrier perspective, that would be a comfort for me. For the retail perspective, I mean, look, it's American consumers.
Yeah.
We're gonna have back to school, we're gonna have Christmas, we're gonna have all that stuff, and so it just depends really on if we can get a handle on the cost of gas and the cost of groceries, because those are the two things that we can't stop buying. If we can get a handle on cost of gas and cost of groceries, I do think the consumer will show up again. At this point, though, with this much uncertainty, that is a non-significant if, or
So
a not insignificant if, rather.
Right. I mean, it does seem to take a lot to really beat down the American consumer. I mean, we've said it for years now. Don't ever bet against the American consumer. Uh, we'll spend our way through anything.
Mhm.
But the interesting thing here, I'd like to hear obviously you have the forward looking component of each of your LMI components. Was there anything that stood out this month based on what you read?
For the forward looking stuff.
Yeah, yeah. What are they expecting? Like, was there anything surprising? I mean, you did call out the fact that inventory levels are not expected to grow meaningfully. I think that's a big deal, considering that
Yeah.
that we do have another round of, and maybe this is obviously before the last tariff was announced, and I want to hear your take on that one, whether or not you think that'll go through or not. But is there anything else in the forward-looking component that was shocking? I mean, they've been predicting prices going up for transportation for several months. Not to
Yes.
this level, but they were largely right there.
They were, and that's that's the when I was talking about the how resourceful supply managers are. One of the reasons I think that is because of how good they are at future predictions.
Right.
I mean, our all we're doing really is crowdsourcing the wisdom of people who know what they're talking about, and they usually end up with pretty accurate forecasts. I would say that yeah. So overall, the logistics index over the next 12 months is predicted to be at 69.4, which is almost exactly where we are now. 69.5 is off by 0.1. And that is above the all-time average of 61. A lot of that driven by cost. So overall inventories, we talked about upstream being at 50. Overall inventories over the next 12 months are predicted to be at 57, which is sort of like a JIT lean inventory approach. And one of the reasons for that is because of the high costs. Inventory costs over the next 12 months predicted to be at 81, warehousing costs at 81.2. And so, it doesn't seem like it's going to get any cheaper for inventories. And basically the future predictions, it seems like folks are using, and this is particularly upstream, is things are going to be more expensive. Wait and see. Let's go as lean as we can. But one of the kind of weird effects of that is, let's talk upstream for a minute. Is that in order to, it's not like we're going to just bring everything over and then stop buying things. We're pulling this sort of cushion forward now, and then let's try to really rotate quickly. And if you look at transportation capacity, upstream versus downstream, upstream over the next 12 months is predicting transportation capacity will be 34.1. Downstream's 54.1. So it's like a 20 point difference there. And what that tells me is that manufacturers are expecting, inventories to be relatively low because they're going to be so expensive because it's, levels are 50, costs are 84. It's a 34-point spread, which would be the biggest spread we've ever had between the for the relative price increase of inventory. But in order to keep those low inventories, we'll have to turn things over really quickly. And that's why we see a 34 out of transportation capacity upstream. I think overall the number's 40 for, if you put everybody together. And transportation prices in that case stayed at 92. And so that to me says that it's not like we're giving up. Like if we were truly thinking like we're shutting the factories down, all that stuff, we wouldn't see the projected growth for transportation over the next year.
Right.
Basically, it's a shift in strategies where our upstream folks are, let's bring everything over so we don't run out because we got so burned in 21 and 22 by running out of stuff. Let's bring it over at this sort of last, little push we're having now. And then once we built up a cushion for ourselves, let's go to a very sort of lean inventory model where we've right-sized our operations, but hopefully we're not shutting everything down. One thing I thought was interesting with the ISM numbers from a forward-looking perspective is that the orders, right? So orders were up for manufacturing, which you talked about. Their overall manufacturing PMI was 54, but if you go down to the components of that report, the employment index was 48.
Right.
So basically, that said like we're bringing in more stuff but less people, which is funny, right? And what I think that's telling us is, we're bringing this stuff over now, but we're not ramping up production necessarily. We're bringing it over now, so basically, so we can try to maintain over the next year. And so I think that's the order of the day for manufacturers. Try to maintain, keep everything sort of level. We don't want to run out. And retailers are, let's wait and see what the consumer tells us they want to do.
Do we have like we've kind of I mean Craig's done some deep dive research on the data center outputs and how it's influencing the economic. I mean,
Yeah.
turn on CNBC in the morning and it's AI, and that's obviously where a lot of the investment and all the capital is moving. And in that sense, it makes a ton of sense that we would see some sort of fallout internally on this data center build out that we're seeing, especially the power grids and everything that goes along with that. Are you seeing anything in your side that kind of supports what we're seeing on this end? Because for us, we look at flatbed data a lot, which is a lot of that front end construction activity. It will eventually bleed into some of the more consistent van and refrigerated freight downstream. But is there anything there that do you think that's a component of what we're seeing in this ISM pull forward type movement as well?
I think so. Yeah, I do. And it's actually in many ways been a savior for like flatbed, right? Because construction other than data centers has not been that robust.
Right.
And so it's been great for soaking up those volumes. Absolutely. Now there it is, the increased cost that you mentioned of like electricity. Like I saw some in the Wall Street Journal this morning about the cost of electricity in Phoenix maybe is going to go up by 14% for consumers. And I don't know if you've ever been to Phoenix in the summer, but you really need to have the air conditioner on. And so that's tough, right? And for that to be coming at the same time that gas is up 27%, that's hard, right? But on the freight side, so far it's been a boom. Now, you do wonder what the curve of this thing is. Like, are we at peak data center construction? Have we gone past the peak? Is it going to go up more? I mean, it does feel like because of the economic incentives, there's just been kind of this mad rush to build as many data centers as you can. And you do wonder if we're going to, it's not that dissimilar from the rush we saw to build more warehouses 5 years ago. Remember, e-commerce went up from 10% of all retail sales to like 17% in 3 months in 2020.
Right.
And so we're like, oh gosh, we gotta have more distribution centers and fulfillment centers rather in urban areas. And now you drive up and down I-25 and north of Denver, there's a bunch of nice looking buildings that could be fulfillment centers that we didn't end up needing. And so you do wonder what the math is on data centers, because right now the approach is clearly like, well, we'll just grow forever. We're never going to die, and you do wonder if we will hit a point where we're sort of good on how much we need to build, and then where the market will shift after that.
And also, isn't there a natural capacity constraint there that we can only build so much? I mean, I mean, we hit that during the COVID cycle with a lot of the transportation networks, is that you could only ship so much. And then there was just a threshold. Like, I think our rejection index topped out at 25%, and shippers basically that was it. Like they did not ship more because they could not manage it. They didn't have the throughput capabilities. And of course, your Ford F-150s that didn't have their chips, what's the point of building more of them until you finish the ones that are slightly unfinished first? But this feels a little nuanced in the fact that there's so much money going into it. Like, I think I read something by Torsten Slok that was basically like, there was so much, it was almost FOMO for the investors. Like, we're going to build right through inflation and all of the lack of ability to do so that is kind of supercharging that sector.
Yeah, in 2007, we were spending a lot of money on house construction too.
Right.
I don't know if you remember that.
Right, yeah.
It's not like the money always means, good decisions are happening.
Oh, no. It typically does. It means the opposite eventually. Like, I think there's a lot of sentiment around the bubble. I think Jamie Dimon even said it on online the other day that, this does look a lot like something that's a little... And do we ever do anything that isn't a little bit overheated or too cold? Like, we don't really moderate anything anymore, do we?
You know how boring it would be if every month I came on here is like, hey, it's a 61 again. Things are fine. This wouldn't be that exciting. You wouldn't have all these fun little sponsors on the bottom of the screen. Yeah, it wouldn't be that fun of a show.
Yeah, I agree. I mean, it's a wild ride. I think it's the right time for us to have an hour-long Freightonomics because there was so much to unpack here. And I think the rest of the year, there's still like, we thought we were done somewhat with uncertainty in 2025, like with the tariffs and everything, and it just keeps coming at us. Like we don't seem to be able to get through to a layer of, what's going to happen next. Are you feeling any clearer moving forward, or you think this is just going to be persistent?
Man, the U.S. economy is the greatest show.
Yeah.
It's like Lost. It's like, oh, another twist. It's amazing.
Oh, I told my wife I don't need to watch reality TV. I work.
Exactly. No, the one thing that I'm interested in seeing is what are the limits of these new tariffs. And I know, oh, hey, you kept the same music. That's nice, even with the dress code. What is the limit of the new tariffs? That will be interesting to see. And I guess something we'll talk about for the July show, maybe.
Yeah, I look forward. I mean, that'll be right after 4th of July, I guess. So we'll see. Thanks again, man. And thanks for tuning in.
50th.